So Cathie Wood's Ark has had a bad year so far in 2021. After starting the year on a high, their main ETF has subsequently fallen 30% from the peak in February and is down 15% year to date. So Cathie was just asked what she thinks about this, whether she thinks this is just par for the course or if she believes there is reason to panic. So in this video, we're going to hear Cathie's thoughts on Ark, the market as a whole, and break down exactly how this impacts you. So I'm not going to make you wait. Instead, let's just jump straight into this first clip with Cathie.
Let's touch, if we may, on this sort of current pullback. Do you actually welcome that as a long-term buying opportunity for a lot of the stocks you love, or are you feeling the heat a little bit?
Oh, I love this setup. The last time I was on, I think I said that this rotation was good news because it meant the bull market was broadening out. It was strengthening. And the worst thing that could have happened to us is to have the market narrowly focus on just our ilk of stock, the innovation space. Instead, it has broadened out so that year to date, I think it's energy's up 40%, financials are up 27%. And from the peak in mid-February, our strategies are down. The ones that have been hit the hardest, not all of them, are down 30 to 35%. I love that setup. We're at, from our point of view, 5-year time horizon, nothing has changed except the price, and therefore the return, which at the peak of the market and of our strategy in mid-February, we expected a compound annual rate of return of 15% on average per year from our strategies. Now that the prices are down, that number is somewhere in the 25 to 30% range.
You may love the setup, Cathie, but it hasn't been great for your business. I mean, worst start to the month on record. You've seen outflows of $1 billion. How are you managing these declines? And there's speculation out there that if the outflows continue, it would be hard to meet redemptions.
No, well, first of all, I don't have to worry about redemptions. ETFs, the ETF ecosystem is a beautiful thing for portfolio managers. I highly recommend it. So what that means is when I am making decisions, they are investment decisions. I have nothing to do with the flows. The ETF ecosystem, the authorized participants, the market makers outside of ARK, although of course we're overseeing their actions, they are facilitating our flows. And they're doing it in many ways with algorithms and derivatives. I think the ecosystem has become quite profitable for them. So we have experienced no problem. If you look at our spreads, there's been hardly a disturbance in our spreads. As far as flows, actually, we've been very gratified. I think if you go month by month now, this is endpoint to endpoint, we have not seen a month of redemptions yet. I would be... I don't want to say never. I mean, of course, we're going to get redemptions. And in fact, in the ETF structure, when we get redemptions, because of the in-kind nature of redemptions, we are able to offer a much more tax-efficient strategy or portfolio in this wrapper than we ever could have in a mutual fund.
So Cathie makes the point that the bull market is broadening out to other sectors such as energy and financials. While their gain has been at the loss of innovation investments so far, she believes this rotation is a good thing long term. And the reason is this: when one sector outpaces the rest of the market by a huge margin, it's often an indication that the sector is growing too quickly. I mean, if you look back at the dot-com bubble, for example, internet companies were offering returns 10 times higher than other traditional sectors. Now, this can only continue for so long, and when it comes to an end, that is when the bubble bursts. So over the past couple of years, Cathie and Ark have been getting these ridiculously high returns. Their main ETF, for example, had returns over 100% last year. Clearly, that is outpacing the rest of the market. And while it's great in the short term, in the long term, it makes investors more fearful that maybe a bubble is forming. So over the past few months, we've seen innovation investments pull back, while more traditional sectors such as energy and financials have surged. In the short term, this might be painful. However, in the long term, it is a good sign that the overall market is healthy. In fact, Cathie remains adamant on her long-term price targets for her investments. So, if there is a dip as we've experienced, this just means her investment should return higher numbers over the next 5 years. Now, to tell you the truth, I think this is a little bit of a case of rose-tinted glasses. If the investments go up, well, that's obviously good. If the investments go down, that's also good. I mean, in reality, investments going down is clearly not a positive thing. However, I do take on board Cathie's points that this is a healthy move for the overall market. And I think the really key takeaway point from all of this is the importance of long-term thinking with investments. This is something I'm constantly talking about. If you invest in ARK and expect to make money in the next month, you're gambling. If you take a 5 or 10 year approach though, these could be some of the most innovative and best investments out there. So with all of that said, let's hear more from Cathie.
A lot of your favorite stocks are the classic stay-at-home plays, Teladoc, Zoom Video, Peloton, and investors have soured on them lately. Number one, because it seems like it would be as good as it gets during the pandemic and a big pull forward in a lot of their revenue. And number two, you look at some of these earnings reactions, and you've seen some really sharp sell-offs and questions about whether they're overvalued. Why are you sticking with them?
Well, we legged into them as in this period. We had sold actually into the because we saw these stocks soaring and many of our others completely misunderstood. So we made some what turned out to be very good moves in terms of their relative appreciation one to the others. And we have been legging back into them in this period because they've been cut in half, most of them. So what you are saying about stay at home and the disaffection with them in the marketplace seems to be getting priced in. And we think these are platform companies. They're for the new world that are harnessing data. And we're in a period now. Many people think we're going back to the old world. I don't think so. Better, cheaper, faster, more productive, more creative we're not going back to the old world. We really, even thinking about digital work. I know at our firm, we're debating exactly what our hybrid strategy is going to be and how it's going to work. But I think Zoom is going to become essential. It is part of the enterprise software stack and technology stack. Communications is the largest part of that stack. And we think that Zoom is going to take a bigger and bigger chunk of that stack. One of the things and from our own experience, we know, Zoom's at its best inter-company. Many people say, well, what about Teams, Microsoft? This is why Slack had to sell out to Salesforce. This is different. Microsoft cannot scale, we don't believe, the inter-company communications. They're very good at intra, and we use Microsoft in-house. But inter, we think that's going to be Zoom's market, and we do think it's going to take more and more of the traditional communication stack.
So one of the big questions at the moment is, what will happen to companies that have thrived because of lockdowns now that the world is beginning to open back up again? Clearly, a company like Zoom is not going to be as popular if we can see people in real life more and video call less. However, what we really have to remember here is that the stock market is forward-looking. It's quite easy to sit here and just say that Zoom is going to be less popular in the next year than it was last year, so it should drop in value. Problem is, investors have already had that thought in the past and invested their money accordingly. That's why the share price today already reflects what people think is going to happen in the future. And so the question isn't, will Zoom be as popular as it was last year? The real question is, will Zoom be more or less popular than people today are expecting it to be in the future. And of course, I'm just using Zoom as an example here, but this could be applied to any of the so-called stay-at-home companies. And Cathie makes the point that we will never fully go back to the old world. Me personally, I've been so fortunate in that I've been able to make an income online for the past few years. My girlfriend though, she used to travel into an office 5 days a week. As everything kicked off, she started working from home like most people, but didn't know if it would last or not. Well, as the UK is beginning to open back up again, her company have indicated that she probably won't have to go back into the office very often, unless she chooses to. And this pattern is really being seen across most businesses. While there might be some companies that insist people travel to the office, and of course some jobs you simply have to, well, overall the past year has changed the workplace forever. And that means the opportunity for someone like Zoom might be huge in the coming years as more and more companies transition to a digital-first approach to how they operate. Now, another question put to Cathie is simply, why are they selling companies such as Apple? Well, let's find out the reason.
What about Apple? Not a typical ARK stock, but you have owned it in a fund, and I've noticed that you've been selling it and in fact have halved your position this week. Why?
Yes, what we do as a bull market extends, as it did last year, we usually put into the portfolio, since we cannot hold any cash, we put into the portfolio, I'll call them cash-like innovation stocks. So the FANGs certainly meet that criteria. They're acting like defensives. They truly are. On days when utilities and staples do well, very often communication services are doing well. So during a period of volatility like we've just seen, we will sell those stocks and move into either our more pure play or earlier stage innovation companies that are being hurt by the risk off.
So ARK have this clever strategy. Because of the terms of their ETF, they can't hold cash. However, there are certain times in the market where they would like to be holding some cash because maybe they think a dip is coming. So instead of holding cash, they move their money into safer companies such as Apple. Now these companies still have upside potential, but importantly, they are not as volatile as most of ARK's holdings. So subsequently, when a dip does come, Cathie and ARK will move their money back out of these safer companies and buy the dip on the investments she is most bullish on long term. So in spite of a tough year so far, Cathie's approach hasn't changed one little bit. She continues to be bullish on her investments, and she's putting her money where her mouth is, as she's buying the dips wherever possible. For me personally, my investments in ARK are for the long term, a minimum of 5 years, and really more like 20-30 years. So I love to see this approach. The last thing I want as an investor is Cathie changing her mind based on some short-term moves. But I'm interested to know what you think. Has 2021 changed your thoughts on ARK at all? Or do you still remain bullish? Let me know your thoughts in the comments below. Thank you for watching, and I will see you again very soon.